Good morning, and welcome to the webcast. This is our 6th session for the virtual 2020 Building Opportunity Conference from Moss Adams, providing insight into current challenges facing companies operating in the built world. Over the span of this conference, we are looking at topics such as how COVID-19 is shaping the landscape of cities and infrastructure, economic impacts of newly passed bills, business planning in an election year, and post-election tax planning and considerations. More information for each session, including registration, are available in the links provided in your resources widget here on On24, as well as on mossadams.com. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement, or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Thank you. And now let's get to our session this morning, state and local tax opportunities. I'm pleased to introduce our presenters from Moss Adams today, Mark Hawkins and Jennifer Young. Team, the floor is yours.
Thanks, Gerald. Yes, my name is Mark Hawkins. I'm a director in the Moss Adams state local tax practice. I sit in the Seattle office, and my specialization is income and franchise taxes.
Thank you, Mark. I'm Jennifer Young. I'm also a director in the Moss Adams State and Local Tax Practice. I'm in Portland, Oregon. I've been with Moss for a little over 6 years and had at least 10 years before that experience in state tax in industry.
Thanks, Jennifer. So this is just a breakdown of how we're going to do the presentation today. So we'll start out with state budgetary forecasts, what state tax, what we can anticipate in state tax legislation or state responses to their budget deficits as a result of COVID. Then we'll move on to really important issues surrounding state conformity to the Internal Revenue Code and how the changes that Congress makes will have impacts on state corporate taxes and individual taxes. And then we'll finish up with a multi-state tax update of significant developments that have occurred in the states with the Oregon, with changes and updates to the Oregon CAT included in that. Now we'll move on to our first polling question.
Wonderful. Our first polling question is, my business owns a portfolio of mostly commercial realty property, mostly industrial real property, mostly multifamily real property, a blend of commercial and multifamily real property, or none of the above. We'll give you a few moments to enter your answers. Remember to click the button next to your answer choice and hit submit. And we'll take a look at the answers momentarily. In the meantime, if you have any questions, please remember to send them into our Q&A section. Go ahead, Jennifer.
While we're waiting for the answers, the responses, Mark, I hear that the Biden tax plan would eliminate the 1031 exchange mechanism. Have you heard of that, and how would that play out for state taxes?
Yeah, thanks, Jennifer. I have heard of that, and I think if he's able to get an elimination of the 1031 exchange with respect to real property through Congress, then I think it becomes important insofar as its impact to the states and how the states would conform themselves to the Internal Revenue Code, and whether or not that tax change would affect the current year, or it would have to wait until the state moved up its IRC conformity to a date that was subsequent to that congressional legislation, which we'll get into in a couple of slides.
Great.
Thank you for your responses. It looks like leading the way at 41% is none of the above, but we have a healthy split amongst the four options provided.
All right, thanks, Gerald. So let's move on to state budgets and revenue raisers for 2021. So at this point, the Congressional Research Service believes that in the aggregate, state budget deficits for the coming fiscal year are going to range between $150 and $200 billion. So unlike Congress, the states, except for Vermont, cannot deficit spend. And so they will need to identify some way to either cut spending, raise revenue, or a combination of both. So what can we anticipate from the states on this issue? First, they can increase audit activity. Indeed, I've seen state auditors not even just dispensing with the process of the audit and just issuing out assessments to the taxpayer and leaving to the taxpayer to address, and having really a post facto audit for the taxpayer to contest the positions. The states can hope that a stimulus program gets through the Congress, much like we saw with the American Recovery Investment Act in 2009. Tax amnesties. Whenever we enter into these difficult budgetary times, states have historically gone through the amnesty mechanism to entice non-filing taxpayers or taxpayers with errors on their returns to fix these things without worrying about being subject to interest or penalties, depending on the language of the amnesty. Tax increases. We're already seeing states move to increase taxes as we get into the next fiscal year. New Jersey actually recently enacted their proposed millionaires tax that would lower the tax base on New Jersey income from $5 million to $1 million, where the 10.75% rate hits. So very high personal income tax in New Jersey for the foreseeable future. Also, New Jersey has extended its corporation business tax surcharge on C corporations by another 2.5% on top of the 9% rate. California, recently the split roll property tax change was not successful in California, and we think that a lot of those legislators were counting on that passage to fill budgetary gaps. Well, with that ballot measure failing, the legislature is going to have to look to other options. In the 2020 session, proposals were introduced to raise income tax rates all the way up to 16.8% on income over $5 million, as well as introduce this new concept of a wealth tax of a 0.4% tax on net worth over $30 million. We'll see if these proposals get reintroduced in 2021 and whether they get traction in the Assembly. New York has proposed to increase taxes all the way up to 11.82% from their high rate of now 8.82%. So it remains to be seen what will happen in New York, but again, New York is in significant budgetary difficulty at this point. Illinois, somewhat surprisingly, had the opportunity to scrap their constitutional provision that limits income taxes to a flat rate, which for individuals is currently 4.95%. That would have replaced it with a graduated rate all the way up to 7.99%. But that measure failed, and so the Springfield will have to go back to the drawing board to identify other revenue-raising options. And then finally, Arizona, the voters there recently passed a tax increase on personal income over $250,000 for personal income for single filers, $500,000 for joint. That in the aggregate gives Arizona taxpayer an 8% rate on income over those thresholds, which is a significant increase given that now it's 4.5%. States could also look to establish new taxes. Recently in Oregon, as we'll get into later on, the Oregon legislature enacted a brand new gross receipts tax called the Oregon Corporate Activity Tax, which is layered on to their existing tax structure. We could look for states to do similar things. Gross receipts taxes are, in theory, are low-rate, broad-based taxes that can generate a significant amount of revenue. Finally, states have the option to broaden what is subject to sales tax. In many cases, there's still a lot of services that are not subject to sales taxes, and states could, as a revenue-raising option, broaden the applicability of the sales tax to more and more services. What states really can't do at this point, because they've already pulled those levers, is to apportion only based on the sales factor, or adopt market-based sourcing, which means you're sourcing services to where the purchaser is receiving the benefit of the service rather than where the service is performed, or even do combined filing. In the top 20 states by U.S. population, anything populated in green means the state has already done that. And so, unlike historic economic downtimes, the states don't have, in a large part, don't have these options anymore. And so they have to be more creative on how they're going to fill their budgetary gaps. So next, we'll move to state conformity to federal tax changes. This is going to be important. This was important when Congress enacted the CARES Act back on March 27th, and will be very important in the coming year as Congress weighs or enacts additional tax legislation that is intended to address these difficult economic times with respect to COVID. So every state corporate income tax ties itself to the Internal Revenue Code when it sets its tax base as federal taxable income. Federal taxable income is tied to the Internal Revenue Code, and then how does the state tie itself to the Internal Revenue Code? Well, states do it in one of two ways. We break them out into either rolling conformity states, which means the state just automatically adopts whatever changes Congress makes to the Internal Revenue Code when those changes are made. Conversely, you have states that are called static conformity states, where the state adopts the Internal Revenue Code as of a specific time, and if Congress makes a change, those changes are not automatically adopted until the state changes its conformity date to on or after that date of congressional enactment. There's a minority of states, especially with respect to individual income taxes, where there's not really any IRC conformity at all. Most notably, Pennsylvania and New Jersey, which have their own very unique systems when it comes to income taxation of individuals. And then you've got a state like Massachusetts, where it's rolling conformity for corporate income taxes, meaning that for corporate income taxes, it will just adopt whatever changes Congress makes. But for personal income taxes, Massachusetts conformity to the Internal Revenue Code is still frozen in time as of January 1st, 2005. So when researching states as to whether or not they're a rolling conformity state or a static conformity state, what is it that we want to look for? In a static conformity state, such as Idaho, what we're going to look for is the definition of Internal Revenue Code and look to see if there's a particular date that is in place for its conformity. And sure enough, Idaho says in its law that it conforms to the Internal Revenue Code as of January 1st, 2020. This means that Idaho did not automatically conform to the Internal Revenue Code when Congress enacted the CARES Act back in March of 2020. Conversely, you've got a rolling conformity state. And what to look for in a rolling conformity state can be seen with Kansas, where the Internal Revenue Code means the IRC of 1986, but as amended. And so it's that as amended language that you're looking for without a particular date being mentioned. So typically when you see these things where the state will say automatically adopt or as amended, those are evidence, that's evidence of a rolling conformity state. So this is a breakout of the U.S. of those states that are static conformity states in green and rolling conformity states in blue. And then you, as mentioned earlier, you still have these unique states such as Pennsylvania and New Jersey that don't really conform themselves to the Internal Revenue Code, and their income tax regimes are fairly unique. Then you have corporate income tax. And as you can tell, a lot of the states are the same color, but there are exceptions, such as North Carolina and Massachusetts. So it's just important to know what tax you're dealing with when addressing issues of Internal Revenue Code conformity. So even if we've got that dichotomy of static conformity versus rolling conformity states, there's still some unique issues to keep in mind. States are not wedded to being rolling conformity or static conformity. Indeed, when the CARES Act came out, New York very quickly, for individual income tax purposes, moved to become a static conformity state for the next 3 years. So right now, for individual tax purposes, even though New York has historically automatically conformed to the Internal Revenue Code, it now, for individual tax purposes, conforms to the Internal Revenue Code as of March 1st, 2020, importantly predating the CARES Act. Then you have states that are rolling conformity states, but then pull back saying that if this automatic conformity to the Internal Revenue Code is going to have too much of a hit on state finances, then we're not going to conform for the particular year. And so Maryland has this funny rule where they're not going to conform to the Internal Revenue Code as of 2020 for the 2020 year, because that's when the CARES Act was enacted. But they were rolling conformity for 2019 because that was a year that CARES didn't apply, even though the CARES had retroactive effect. Then you have a state like Oregon, which is kind of a hybrid, because Oregon has this law in its IRC conformity statute says that it conforms to the Internal Revenue Code as of December 31st, 2018. But then there's this secondary clause that it says that with respect to the definition of taxable income, it's the Internal Revenue Code as applicable to the taxpayer's taxable year. Well, when we're talking about state income taxes, what we're most concerned with is the definition of taxable income as determined under the Internal Revenue Code. So for the most important part of state corporate income tax or individual income tax, Oregon is effectively a rolling conformity state through this secondary clause. And then Colorado has a relatively unique approach as well, because via statute, Colorado is a rolling conformity state. But the Department of Revenue, through regulation, has in essence said that statutory changes made by the Congress after the end of the taxable year do not have effect for the current year. Now, this is a pretty aggressive move by the Colorado Department of Revenue, and it's an open question whether the DOR, through regulation, can, in essence, contradict a statute. So I think that's going to have to be challenged by taxpayers if they want to obtain the benefits of the CARES Act in Colorado. One thing that is going to come up in the 2020 filing season are aspects of the CARES Act that have impacts to taxable income, notably the forgiveness of Paycheck Protection Program loans. Currently, under the CARES Act, the PPP loans are excluded from gross income, but the IRS has said that to the extent the amounts are excluded, you can't take those as deductions, so no double benefit. But for state purposes, it's all going to come down to how is the state going to conform itself to the Internal Revenue Code? If it's a rolling conformity state, it's likely that there's not going to be any change with respect to PPP loans on your state return from your federal return. But if a state is a static conformity state and its conformity predates March 27, 2020, then you're going to have an adjustment unless the state has alternative guidance. So a state that conforms the Internal Revenue Code as of, say, January 1st in 2019 and hasn't moved up its tying into the IRC, you're likely going to have an adjustment. So you would, in essence, have an addition adjustment equal to the amount of the forgiven loan, but then because the loan was actually sub-state tax, presumably you would get a deduction for the expenses incurred with respect to the PPP money. So it's just important to look at what states that you're dealing with and how you might approach the modifications to income line items on the state returns. And then secondly, always look to see if the state has particular guidance. For example, in Massachusetts being a rolling conformity state, the Department of Revenue has said there's not going to be any difference with respect to corporate income taxes because we conform to the Internal Revenue Code as it's amended. Then you have this really unique example in Indiana where Indiana conforms to the IRC as of January 1st, 2020, but then the Department of Revenue goes on to say that they don't view the debt forgiveness provisions as a change to the IRC. And so they will still follow the exclusions from gross income related to the forgiveness of loans, notwithstanding its IRC conformity predating March 27th. So this is why it's important to go through each individual state just to make sure that you're getting the right treatment on the return. Here's a list of where we're at with respect to Internal Revenue Code conformity in the Western states. At this point, the only states where we're not looking at, where we don't think that, where we think we'd have like a paycheck protection loan adjustment would be states like Arizona. California actually, even though it conforms to the Internal Revenue Code as of January 1st, 2015, as we'll get into the slides, it has made an exception with respect to the PPP loan forgiveness program. Idaho is still frozen at January 1st of 2020, but yeah, I think that's it. I think Hawaii actually recently moved up to conformity to March 27th, which is the date of the CARES Act. Now we'll move on to our second polling question.
Thank you. A reminder for these polling questions: to qualify for CPE credit, you will need to answer 3 of the 4 questions. This is our second one, and it reads, a taxpayer that obtained a PPP loan and received loan forgiveness doesn't need to report anything for Idaho because Idaho adopts the IRC as of January 1st, 2020. Is that true or false? And we'll give you a couple of moments to answer that question.
While we're waiting for the responses, Mark, I see that there are big conformity issues, so real differences between federal and state taxable income, and also differences that can apply between corporate taxpayers and individual taxpayers. And that brings up the question, the pandemic may be causing a lot of taxpayers who didn't have net operating losses before to have net operating losses now. What should they do?
Yeah, they should really reach out to their people or their providers that specialize in state and local taxes, because this issue, especially involving NOLs, can be very complex when it comes to both corporate and individual taxpayers. In many cases, corporations don't even tie themselves, or states don't even tie themselves to the Internal Revenue Code section that deals with net operating losses. Instead, state NOLs for corporate tax purposes are their own unique creation under state tax law. And so whatever changes that Congress may make with respect to NOL carryback just don't have any impact to that particular state, because the state just attaches itself from those NOL provisions. And even in cases where the state does tie into the federal NOL provisions, in many cases the state just doesn't allow carrybacks. It's only about 10 states for corporate income tax purposes that allow carrybacks to begin with. And then with respect to individuals, for individual income tax purposes, state losses are really tied into what is going on for federal purposes, given that in many cases the starting point for state individual income taxes is federal adjusted gross income. So the net operating loss provision is embedded in that starting point. And so this can create a lot of complexity for non-residents, where they may have a loss that is flowing through a pass-through entity in a particular state, and their overall income is negative in that state. But if they have positive overall federal income, they actually may not have a loss for that particular non-resident state. So again, it's a very complex issue, especially with respect to individual taxation.
It's good to know.
Thank you. The answers for the last polling question have been recorded, and 2/3 of the audience are going with false.
Thank you, Gerald. We're going to switch now to some specific state tax updates driven by changes in state law as opposed to federal law. We're going to be focusing on the western and southwestern states. Before we do that, we do have an additional polling question.
Our third polling question for today reads, the COVID-19 pandemic hasn't had any impact on commercial or residential rent collections. True or false? And we'll allot some time here for your responses to come in. Okay, we are approaching 70, about 3/4 of you have responded. Very good. We'll be closing the poll momentarily. Very good. The results are overwhelmingly false at 94%.
Thank you. I anticipated that would be the answer. I know I said that we'd be speaking specifically on Western states, but there are some general considerations for property taxes that are driven. The ultimate cause is the COVID pandemic, which created some federal law changes. The federal law changes have caused many taxpayers to engage in cost segregation studies to potentially get greater depreciation amounts and even create net operating losses that can be carried back. And then also, of course, per the prior slide, I imagine that the COVID-19 did not really drive a lot of increased rental collections, and it's more likely decreased rental collections. So property tax valuation appeal season is coming up, and it's quite likely that the income from property, both residential and commercial, has been impacted by COVID-19. And so that could be a grounds for an appeal. Those dates can have a fairly short fuse on them. So when you get assessments of market valuation, if you're in a state that updates its assessed value based on market value, it'll be very important to track those dates, especially if you're in multiple states. Some general considerations for income tax as well are again, the pandemic has really driven a sea change into how business is conducting businesses now, particularly with respect to working from home practices. What this has done from a practical perspective is that companies and businesses that never had any presence in a state before may now have a presence due to employees now working from home. And so many states have, realizing this, have published guidance that employees temporarily working from home due to COVID don't necessarily create nexus for the employer. 3 of the states in our western, southwestern state area, Arizona, California, and Oregon, have issued guidance with respect to this. But it is a state-by-state determination. Another important thing to keep in mind is that current guidance, even if the state says that employees temporarily working from home due to COVID aren't going to drive a change in your state tax filing responsibility or state tax liability, that guidance might be temporary. And so when a state of emergency ends, it's possible that that guidance will expire as well. And a business that has continued to keep working from home in place could now have a state tax filing responsibility and a filing obligation. Another important consideration that sometimes escapes notice here is local taxes. Local jurisdictions may apportion income using a payroll factor Seattle business and local jurisdictions in Washington with business and occupation or B&O tax, such as Seattle, apportion receipts in part using a payroll factor. Or they may also look to where employees are performing the services in order to assign receipts for purposes of determining taxation. Portland and Multnomah County, Oregon, both use that kind of a metric to assign receipts to the local jurisdictions. Moving on to some specific recent state developments. A big one in California that's quite recent in late 2019 is the appeal of Metropolis Trust. This is one, it was held by the California Office of Tax Appeals. What happened here is that some non-resident trusts owned interest in Pabst Corporate Holdings, Inc., which was an S corporation. So income generated by Pabst Corporate Holdings flowed through to those S corporation shareholders. Pabst Corporate Holdings, Inc., in turn, owned a Q-sub, Pabst Holdings, Inc., that operated in California as well as in other states. Pabst Corporate Holdings sold its interest in Pabst in a transaction that was treated as an asset sale for federal income tax purposes. There was a 338H10 election made. And as is often the case in these transactions, the primary asset, so most of the gain that was generated by the Pabst Holdings Inc. goodwill, so just value of the business overall. And that gain was, under interpretation of California rules at the time, PHI allocated the gain on those intangibles to the resident state of the ultimate owner. The California Office of Tax Appeals held that that gain, instead of being allocated, should be apportioned to California based on the business done in California. And that generated a significant assessment for the shareholder. That decision is on appeal, but it's been marked precedential at this point. California is auditing taxpayers that reported federal gains if nothing was assigned to California. Either it was all allocated outside of California as non-business income, or even if it was treated as business income, it was assigned to the resident state on K-1s that the flow-through entity filed. So it's an action step, important to review previous returns in that light and see if there's a potential exposure there. Review proposed transactions and make sure that you discuss that with your tax advisor, because that could be a significant tax impact. Some recent legislation in California deals with net operating losses. So the use of net operating losses for both corporate tax and personal income tax has been suspended for the tax years beginning in 2020 through 2022. That doesn't apply to corporate taxpayers with income subject to tax of less than $1 million. It also doesn't apply to individuals with net business income or modified AGI of less than $1 million. The consensus is that this limitation is not very generous, that it's pretty restricted in scope, that it's pre-apportioned. So that would be under $1 million in total before taking account of the extent of your business done in California. Now, if a loss was incurred before 2020 and couldn't be used due to this suspension, the carryover period does get extended. Another significant development here deals with California credits. Those have been restricted so that only $5 million of credits can be used in a given year to reduce California income tax liability for 2020 through 2022. I'm sorry, we have a typo there. Doesn't apply to low-income housing credits, personal credits for individuals, or the renter's credit. Again, these are strictly budget-driven considerations. Finally, California does conform to the Federal CARES Act for PPP loan forgiveness, which Mark discussed in detail earlier. So the gross income doesn't include any amount forgiven. and deductions attributed for eligible extensions to the extent of the forgiven loan amount cannot be taken on the California return. There were two property tax-related ballot measures that would have applied statewide in California. As Mark noted, Proposition 15, which was a split roll. I don't believe that's been formally certified, but the consensus is that that is going down, that will not pass. Proposition 19, however, did pass. That expands some breaks for older homeowners, and it also tightens the rules for transfers from a parent to an adult child. Alphabetically, we come to Colorado. So Colorado had two statewide measures. Both of them passed. Prop 16 cut the tax rate by over 17% from 4.63% to 4.55%. Significant reduction in the income tax rate there. Amendment B on property taxes, that also passed. There was a constitutional requirement that residential and commercial composition of property taxes stay at the same relative contribution percentage, and so that restricted property tax assessments. That requirement has been repealed, so look for big changes in Colorado property taxes. Moving again alphabetically, if not geographically, some significant changes in New Mexico as well. So as of July 1st, 2019 now, New Mexico has implemented economic nexus for gross receipts tax purposes. It's a $100,000 threshold, and the measurement is the previous calendar year. The gross receipts tax functions, in effect, somewhat like a sales tax, and that if you are buying something taxable in New Mexico, you'll see this tax on your, most likely you'll see it on your receipt. However, it is a tax on the seller. It's not a tax on the purchaser. And the rate, the rates are high, and there are high local rates as well. The measure of the tax is also significantly broader than for many state sales taxes. Most services, for instance, are subject to this tax. Government entities are not necessarily exempt. And so it's an important tax to take a look out for. Wholesale purchases are exempt, but certificates have to be issued by the purchaser to the vendor. Just touching on a recent tax that was effective, it's been in effect for a year now, the Oregon Corporate Activity Tax, or the CAT. I believe that most people doing business in Oregon are aware of this tax. It starts with Oregon-sourced gross receipts with some exemptions, a subtraction for certain subcontractor labor, a limited subtraction, a subtraction for a percentage of cost of goods sold or labor costs, $1 million exemption, and then a 0.57% or $5,700 per million rate plus $250 is Oregon CAT. The calculation itself is pretty trivial and is, could almost be noted on a napkin, but each line item that comprises that calculation can, what is Oregon commercial activity, what activity is exempt, what do you put in your COGS or labor cost, and how do you apportion that subtraction. Each line item there is complex, industry specific, and can even be taxpayer specific. And the skeleton calculation provided in the Oregon statutes really doesn't capture these intricacies. So you'll definitely want to review your specific fact situation with your tax department or your tax professional to determine each item before dropping the results into the calculation. One very significant exemption that the Oregon Department of Revenue has provided some recent guidance on is amounts that are received as an agent. That has always been in the statute ever since the statute was passed in May 2019, but Oregon has just in 2020 provided some guidance here. So an agent is a person who is acting on behalf of another and subject to that person's control. And the Oregon guidance, Oregon Administrative Rule 317-1100, states that all facts and circumstances are considered in determining if a receipt is received as an agent. If any of you are familiar with the Washington B&O treatment of reimbursements and amounts that are excludable as they were received as an agent, Washington gives some very detailed, very restrictive guidance, but there's also some kind of black lines that Washington provides. Oregon so far has not done that. It seems to be more of a facts and circumstances test here. In the most recent rule, the first iteration of the rule wasn't terribly helpful, but after receiving a lot of comments, Oregon has provided some specific examples now, and the rule really is much more helpful. Incredibly helpful examples are provided for contractors, and one where a contractor receives amounts that are exempt, and one where a contractor received amounts that are not exempt. Under a fixed price contractor where the contractor bears all the risks and has no real responsibility to its principal with respect to subcontractors, the contractor is not an agent for what it receives there, and all receipts are included in CAT. On the other hand, if the contractor is working under a cost reimbursement contract, and the contractor is acting on the behalf of and under the direction and control of its principal in the use of subcontractors, then the amounts it receives to pay the subcontractors are excluded, although any cost plus fee it receives would be included. So a big takeaway here is that it's necessary to review each contract. Obviously the answer on what's included and what's excluded can vary specific to a particular contract. Some issues and updates that have popped up and some pretty significant gray areas on the CAT are the issue of a unitary group. A unitary group for income tax purposes can be very different from a unitary group for CAT. That's important. The CAT does require that a unitary group, which is defined as a group of entities that have more than 50% common ownership, either direct or indirect, that operate in a unitary business, and there's the definition of a unitary business is quite similar to the income tax definition of a unitary business. But the big difference on the CAT here is that the threshold is 50% for CAT, it's 80% for income tax. And for CAT, a unitary group can include flow-through income, a unitary CAT group will include flow-through entities, including S corporations, partnerships, LLCs, whereas a unitary income tax group generally does not. A big question in this area is, are family members treated, are the interests of direct family members aggregated together to determine whether there's common ownership? Statute and available rules don't really speak to that right now. For other gray areas, the CAT statutes and rules, this is a new law. The Department of Revenue has been issuing guidance ever since late 2019, but the statutes and the rules don't address every situation. This is a unique tax. And so there is a process to request anonymous advice from the Oregon Department of Revenue. That's called a construe request process, and that's something that you can discuss with your tax provider as well. 2 new local taxes in Oregon effective January 1, 2021. We'll go over these pretty quickly. They are both in the Portland metropolitan area. There's a metropolitan area supportive housing services tax, often called a homeless tax. That is a 1% tax on income on individuals and businesses. So individuals pay the tax and businesses pay the tax as well on income that's derived from sources in the Portland metro area. That's mostly Multnomah, Clackamas, and Washington counties, but the metro boundaries, legal boundaries, don't line up perfectly with the county boundaries. So it's important to look at the metro area and also the sourcing provisions, because they can be quite different from how Oregon apportions income. So the same income that might be apportioned to Oregon is may not be apportioned under the rules for this metro tax. Multnomah County Preschool for All tax just passed last week. that's a tax on individuals only. It's not on entities. These taxes, both of these taxes are in addition to the current Portland-Multnomah County business license and business income taxes. We don't have guidance yet from Multnomah County or the Metro Council. The Metro Council is meeting on November 17th, and I believe there will be an agenda item to discuss some rules here. Moving into the Southwest, Texas margins tax. Texas has implemented economic performance effective July 1, 2019. The threshold, unlike New Mexico, which is $100,000, the Texas threshold is $500,000. The Texas return is filed for the entity's exercise of its right to do business for the year based on prior year information. So returns that were originally due May 15th, 2020 are for 2020, not for 2019, and so economic performance rules would apply there. The Texas sourcing rules still refer to services performed in Texas. They haven't fully moved to market sourcing. However, in a recent decision, the Texas Court of Appeals defined services performed in Texas as final services that provided value to the customer. And it kind of led to de facto market sourcing in the case of Sirius XM radio. So if you're performing a service for a Texas customer from a non-Texas location, review those rules and discuss it with your tax implications with your tax provider. We've had some big changes in Washington as well. Local business and occupation apportionment rules. We mentioned earlier that many Washington local jurisdictions, not all, pretty much all Washington local jurisdictions have their own sales tax, but they don't all have their own B&O tax. Jurisdictions that do have a local B&O tax, though, have changed their rules for sourcing from a where are you performing the services to where are your customers receiving, where is your market for those services. That sourcing rule lines up to the sourcing rule that Washington uses for state B&O. So those are now pretty aligned. One thing to look out for, though, if you do file a B&O return in a local Washington jurisdiction, is that there is a throwout rule for these, so that if under the market sourcing, you would source receipts to a local jurisdiction where you're not taxable based on certain criteria, those receipts, they're not thrown back to the local jurisdiction, they're not included in the numerator, but they're excluded from the denominator. And so that can lead to a higher than expected apportionment factor for local B&O. A key takeaway here is that Washington B&O, unlike Oregon CAT, there's no unitary group analysis, and so if you have separate entities that are providing services for each other, it's very important to review those services in line with the new receipts sourcing. This could increase your B&O in some jurisdictions and decrease it in others. Seattle implemented a new payroll expense excise tax that will be effective January 1. It's imposed on persons that have more than $7 million of Seattle payroll expense. Payroll, unlike what we classically think of as payroll, it does include payments to independent contractors. So it's important to really look at all of your labor charges to see if you meet that threshold and are subject to the tax. It's a fairly complex rate structure. So if you've got more than $7 million of Seattle payroll expense, this is something to discuss with your tax services provider. Washington also made major changes to its real estate excise tax provisions. These were effective the beginning of 2020, January 1. There's a new bracketed state rate structure for sales prices. So now, instead of a flat rate now, it ranges from 1.1% to 3%. There are some new rules on controlling interest sales. This is a big change. Washington has always had a rule that a change in ownership can trigger REIT, even if the ownership change is the change in ownership of an interest in an entity that owns real property, and not just strictly the change of ownership of the property itself. That threshold the threshold is still an over 50% change, but it now applies, instead of a change within a 12-month period, it applies to any change in a 36-month period. And any transfers of interest of 1/6 or more of an entity that owns real property in Washington need to be reported, or significant penalties can apply here. Local jurisdictions also may have their own real estate excise tax. I believe that brings us to our final polling question.
Yes, indeed. Our final question for polling here reads, I think I want to move my home and business from the Pacific Northwest to Nevada. How do I guarantee I won't be taxed by California, Oregon, or Washington? A, if I change my voter registration, my driver's license, and get a new library card, I'll be fine. B, I'll need to post updates on social media telling my contacts that my new address for tax purposes might be Nevada, but they can still find me in Portland. C, as long as I live in Nevada, I won't be taxed on selling Washington real estate. Or D, states can frequently audit individuals filing non-resident or part-year resident returns. They can be pretty intrusive, and I can't guarantee I'll win, especially if my business still operates partly in these states. I should contact my tax advisor. So we'll go ahead and wait for answers to come in. We also invite you to have you submit any content-specific questions through the Q&A function here as well.
So, Jennifer, what do states look for, state revenue authorities look for, in identifying or giving an indicia whether the person at issue is a resident of that state? What sort of pieces of evidence are they likely to focus in on?
These can be extremely comprehensive and intrusive audits. There's no one kind of silver bullet checklist where you can just tick all the boxes. You're going to meet the requirement here. So states have looked at, most taxpayers know they should change voter registration, change their driver's license, change their mailing address. But, states have expanded, and residency has been found when, for instance, a person registers for a hunting or fishing license in a state and checks the residence box. That's been held to be indication of residence in a state. States are also now, they are able to mine social media. They can and do. And so messages on social media that indicate, that you haven't changed your residency, or that you still are maintaining really significant ties in the state, could be used against you. On the flip side, that might be an opportunity to just increase the body of your documentation that you have actually moved. Many tax providers, including Moss Adams, have residency practices to discuss residency transitions with individuals, talk about many of the factors involved. It can be complex as well. Estate tax can be, as well as just state income tax, estate tax might be something that should be considered. So it really shouldn't be done lightly. It's not like you can just pack a suitcase and move and not pay state tax anymore. It can be sort of a lengthy transition period that involves a lot of factors.
Yeah, I started my career in Ohio, and on any sort of residency issue that we come up with Ohio, because we would see a lot of people retire and move to Florida. And the first thing that Ohio would do is to see if the individual in question had taken a homestead exemption on their real property taxes. So Ohio has this provision that you can reduce your property tax values by 10% if the real property in question is your primary home. And so if the individual had moved to Florida but was still taking a homestead exemption on their Ohio real property, in essence, they're telling the state that their primary home is in Ohio, which would significantly weaken their case of Florida residency.
Yeah, that's a good point.
Thank you. And here are the poll results, with over 80% of the responding audience concluding that should contact their tax advisor.
it looks like we have the consensus is contact your tax advisor that this is complex, and we definitely agree.
So we had a couple of questions out there. So there are a couple actually involved very recent potential changes to federal and state taxes. One deals with the recent sourcing rules that are being promulgated by the Texas Comptroller. In essence, Texas historically has sourced service revenue to the location where the service is performed, and the regulation is seeking to incorporate expand on where the service is being performed to, in essence, the end product act, the final customer interface that receives the service as being the most important controlling factor as to where the service is performed. And you see this a lot, or you would think that this would have the potential to really change the sourcing methodologies for a lot of services that are being delivered electronically or through a broadcast format, such as Comcast or SiriusXM. Indeed, SiriusXM, as Jennifer alluded to earlier, this whole case dealt with whether the Comptroller's office could use the End Product Act to attribute revenue to Texas when, in essence, SiriusXM was performing all the revenue-generating services in large part outside the state. So right now, SiriusXM has lost that case in the Texas Court of Appeals, but we do know that they have petitioned for review with the Texas Supreme Court, so that case is not over yet. But if the regulation goes through, then an additional challenge for taxpayers would be to say that the regulation actually contradicts the statute, and it would be if Texas wanted to adopt the end product test for source and service revenue, then the legislature would have to do it in the statute, and it can't be done through the regulation. Another question that came up related to the proposed California net worth tax. The California net worth tax introduced this concept called the temporary resident. And a temporary resident is an individual that is neither a California resident nor a part-year resident. A part-year resident is someone that either is moving out of California or is moving into California. But a temporary resident is something that I've actually never seen in state tax law. And it is a person that doesn't meet either of those two criteria, but they are in California for more than 60 days. Or they spend more than 60 days in a year in California. And if they're a temporary resident, then you take their net worth base and multiply it by the percentage of days they spent in California, and that becomes their tax. So if this tax were to be enacted and they kept this temporary resident provision in, people that were not California residents would have to be very mindful of the amount of time they spent in California to avoid tripping this temporary resident designation.
We do have another question on an IRS bulletin that was just published today on flow-through entities like S corporations and partnerships that make state tax payments on behalf of their owners and members, and whether or not kind of a loosening or another interpretation of what might be subject to the SALT cap, the $10,000 limitation on state taxes that can be deducted for federal returns. There are, I believe, 6 states that have an election for an entity to pay tax at the entity level. Wisconsin, Louisiana, Connecticut, I believe Rhode Island. A couple of other states have that election, and the IRS bulletin seems to speak directly to those states. However, there are other states that have other types of payments that can be made or are mandatory, such as the Alabama mandatory composite tax payment. It's still a composite. It's made on behalf of the members. It's not the entity level tax. And then there are other states that allow an entity to elect to make a composite tax. And the position so far has been that those taxes flow through to the owners and members and would be subject to the SALT cap. But the full ramifications of this bulletin that just came out this morning is something that we, as well as many other tax practitioners, are kind of examining in real time to see exactly how it's going to apply.
Thanks, Jennifer. That was a great explanation. Yeah, it's 2020-75. I think there's a ripe opportunity to do a lot of rulings with the IRS to get clarity with respect to specific taxes on pass rallies in the states.
Definitely. I believe.
All right. So,
go ahead.
Yes, I believe we've reached the bottom of the hour and the end of our time here today. Any brief closing thoughts before we conclude?
No, I think it's going to just be very important to evaluate what Congress does and with the retroactive effect that those tax laws may have, and how states marry up to those laws, because it could affect how we do estimates in the coming year, as well as truing up any 2020 estimates with the final payments that come due in March and April.
Understood. Well, thank you, Mark. Thank you, Jennifer, for your expertise shared on today's session. And thank you to the audience for attending state and local tax opportunities as part of our virtual 2020 Building Opportunity Conference. In a few short moments, a webcast survey will be launching in your browser for you to send in some feedback for us. We greatly appreciate your time and effort to fill that out. For more information regarding our upcoming sessions, closing out the conference this week, as well as our National Practice for Construction and Real Estate, please visit mossadams.com. We also have more information in your resources widget here on On24. Thank you very much, everybody, and we hope you have a great day. We hope to see you again at a future event soon. Take care.